Excuse me, Suman ma'am. Can we start the program?
Yeah, hi Sabha. Thank you. I was told that there will be some prayer and all that. Can I start the program?
Yes, ma'am. We are starting, ma'am. Yes,
Can I start the program?
yes, ma'am. Assalamu alaikum wa rahmatullahi wa barakatuhu, and a very warm afternoon to one and all virtually present here. I quote, being in control of your finances is a great stress reliever. I unquote. On behalf of Justice Bashir Ahmed Said College for Women, we welcome you all to the webinar on financial wellness in commemoration of World Investor Week 2022. Now let's commence the program with the holy blessings of the Almighty. I request Hadia Fatima of third year BCom ISM to recite few verses from the Holy Quran and read its translation.
Assalamu alaikum wa rahmatullahi wa barakatuh. Surah Al-Fatiha. Bismillahirrahmanirrahim. Alhamdulillahi Rabbil alamin. Maliki yawmiddin. Iyyaka na'budu wa iyyaka nasta'in. اهدنا الصراط المستقيم صراط الذين أنعمت عليهم. Surah Al-Fatiha translation. Bismillahirrahmanirrahim. All praise is for Allah, merciful, the master of the day of judgment. You alone we worship, and you alone we ask for help. Show us the straight way. Have gone astray. Jazakallah khair.
The corporate secretaryship will deliver the
Assalamu alaikum and a very good day to everyone virtually gathered here. And head of the department and Information Systems Management, it's my privilege to welcome you all to the webinar of Financial Wellness conducted by the department. And I deem it as an honor in introducing the resource person of the day, Ms. Siman K. Karant, SEBI Security Market Trainer, who has over 16 plus years in experience in banking and wealth management. Being an MBA graduate for in marketing towards individual requirement and portfolio management for over 2 years, and also with Quota Group 4 years, building management solutions for HNIs. With her vast experience in the financial service industry across the asset class and for well-known entities in financial space, on topic related to stock market, basics of investing, cryptocurrencies, etc. I take immense pleasure in welcoming.
Thank you, Halima. Now welcome the resource person, Ms. Suman K. Karan, Steady Security Market Trainer, to address the gathering. Welcome, ma'am.
Thank you, all three of you, Sabah, Fatima, and Halima, if I'm right, and for women. Today we are here to talk about. Let me, Halima has done the job of introducing me, so I will not go ahead and do that. So let us straight away delve into the review. So
a post-lunch session. Let us keep it a little more interactive and fingers on your phone so that it's interesting for both of us, and you also get to. We've gathered here to talk about investments. So let us first understand why invest. I'm sure most of you would know, but I'm just for your favorite option. What, according to you, is the reason why you should be investing? Is it for our future, to achieve financial goals, for children's higher education, or to buy a house? Let us quickly run through the poll and take things forward, just making it a little more interactive. For our future seems to be taking the lead. To achieve financial goals, say many. Nobody wants to buy a house, looks like it. Just another 1 minute more and I'll end the poll. Okay, so for our future, I'm ending the poll. So for our future seems to have taken the lead. While all these 4 options are correct, we want to invest for our future, to achieve our financial goals, for children's higher education, to buy a house, for retirement, for funding your own marriage probably, or your children's marriage. All these answers are correct, but a more appropriate answer would be to achieve our financial goals. Why? Because financial goals is a way of understanding in numbers what it is that you need. Financial goals planning will include all these aspects of children's education, children's marriage, buying a house, retirement. All of them are included if you do a proper financial goal planning, where you will, and at what inflation rate. For example, if you're looking at children's education, for example, I'm sure most of you are not even married as of now. When you get married, you will have children, and when you're planning for their education, say you want to plan 20 years down the line. In today's terms, if you need 50 lakh rupees, after 20 years, that 50 lakh rupees would be much more, because inflation in the education segment is at 10%. So putting a 10% inflation on that 50 lakh rupees, that will be worth much more 20 years down the line. So you need to accumulate corpus for that. So that is how we look at financial goals. Okay. Now we understand financial goals are the reason why you would want to invest. But when you want to invest, you are all looking at lucrative jobs going forward. You're all in. So let us see what according to you works best. What is the equation that works best for you? There is another small poll. Is it income minus savings is equal to expenses, or income minus expenses is savings? What according to you is the right option? Yes, income minus expenses is equal to savings, same many. But I'm ending the poll here. Okay, let me give you a clarity on that as to why. Now, if you have say 2,000 rupees or 5,000 rupees in your wallet and you go to a mall, and how many of us are sure that we are going to come back home with that 5,000 rupees intact in our wallet? Hardly any of us, right? So 2,000 rupees or 5,000 rupees in the wallet, but we will, that is the nature of impulse buying and temptations. So any amount that you will have in your accounts, you will end up spending it end of the month. So ideally what you should do is, beginning of the month, you sit and jot down what are your expenses, and you set aside a certain amount as savings, and you build the discipline of saving that amount on a monthly basis, and you arrive at only the go about investing. Okay. So now we understand. I hope the presentation is visible for everybody. Yeah. So So we understand income minus savings is equal to expenses. Now, and I also need to understand which financial goal comes first and which comes next. Okay. Now, how do we go about investing? If we understand now that income minus savings is equal to expenses, and we have to start investing towards our financial goals, how do we go about investing? Okay, the basic rule, always remember, is about 50-30-20 rule. There is something called as a 50-30-20 rule. 50% is to be invested towards your needs. What are your needs? Food, shelter, medical expenses, these can be categorized as your needs. Like, for example, the last 2 years during COVID times, a lot of people found it very difficult because many lost jobs and there were a lot of medical emergencies in families of many people. At that time, if you had invested in equity and the equity markets are not doing well, it makes it very difficult for you to pull out the money in time, right? So those kind of medical emergency funds is categorized at 20%. At any given point in time, you should have 20% of your money kept easily accessible, readily accessible, maybe in your savings bank account or in liquid funds, which is readily and easily accessible for you to pull out at the time of need. What are your wants? Wants are the luxurious items which tempt you every now and then, and all of you will have a list of these items which you will want to buy, say 6 months down the line or 1 year down the line. You want an iPhone, you want to buy a fancy car, or you want to go on a vacation to Bali. So all these things come under your wants. Okay. Now here, please understand, you may be saving a lot of money when you enter into your corporate world and you have good salaries. You want to set aside a good portion of your salaries into savings, but keeping it in the bank account will not help. So if you're keeping it in the savings account, the earning that you're making on it is just 4%. So in that 4%, you will also be ending up paying taxes, and you also have investing that money in the right portfolio, which is giving you the right amount of returns, is what will help you achieve your financial goals. So let me just quickly share a retirement calculator so that you understand how to go about calculating. Okay. See, what you need to understand here is that there are different financial goals which arrive at different points in time in your life. Prioritizing these goals is very, very important. Now, in the previous poll, you saw that, children's education, many of you have voted. For our future, many of you have voted, right? In all these financial goals, which is the most important financial goal? You can always tell me what is the most important financial goal. Anyone? So I'll give you a few examples. There is, you may want to fund for your own marriage, children's education, children's marriage. You want to buy a house, say 10 years down the line. You want to save for your retirement. You want to go on a holiday. All these are financial goals. What, according to you, is the most important financial goal? What do you think should take priority when you're planning? Yes. Children's education. Anyone else? You can chat also and tell me. You can even chat up and tell me. Emergency expenses, says Pradneel. Anyone else? Anything else? Okay. Saving for retirement. Yes, Halima. That's absolutely correct. So, saving for retirement takes the priority among on your careers and embark upon your journeys. So, retirement is a very long way ahead for you. But always remember, retirement is the most important financial goal, mainly for two reasons. One, because when you retire, your salary stops, right? Maybe you will have certain passive incomes coming your way, but your main form of income, which is your salary, would have stopped. But your expenses will continue to exist, whatever is the amount, right? So when the expenses continue to exist and you don't have any income, it becomes very difficult to cater to those expenses. So you will end up depending upon people, right? When you're depending upon people, they may not be willing to look after you. In some cases, they may be very good and they would want to look after you. But in the other cases where they would not want to look after you, it is always better that you have planned for yourself for your own safety. That is one reason. Second reason is because of the advancement in the healthcare industry, what is happening today is the life expectancy has gone up way ahead than what it was, say, 20 years back. Today, the life expectancy is 70 years. So it is always better that you plan for the worst. The higher, the better. What according to you do you think we should plan for? How many years would you think is ideal? 90, 80, 90, 100. It's better you chat up and tell me, because I have muted all the participants. So it's ideal that you chat and tell me. Early 50s. Early 50s, Halima, might be the age that you want to retire, but even prefer to work even after they retired. But today's case, that is not the case. If you ask people when you want to retire, it's strenuous, and you would want to retire at say 40 or 45, the earlier the better, right? But here, for our calculation sake, let us look at 60, and so the number of years for retirement is 35, and I'm considering, please look at these calculations. In today, I'm assuming that you need 30,000 rupees to take care of your monthly expenses. Let us look at a bare minimum inflation of calculation. We're looking at 60%. When you retire, yes, after at 2,30,000 rupees. I hope this number is visible. This is not an exaggeration, but this is the power of compounding over a period of certain number of years. Now here we are looking at 45 years, and we are looking at 6% inflation year on year on that 30,000 rupees. So to cater to the same standard of life that you have today, which you can afford to in 30,000 rupees, you will need to 2,30,000 rupees after 30 years when you retire. Now, how do I fund for this money? Rest and create a portfolio, and that portfolio is earning, say, X percentage of returns. Through that portfolio, I am drawing and catering to my 2,30,000 rupees. What is that corpus that I have to save for? So, if you look at the values, when you retire, you don't want to take any risk on that corpus that you have created. Whatever corpus you've created, you want that monthly expenses. So we are looking at a very conservative or a moderate return of say 9% on that. When we look at that, the corpus needed is 5 crore 62 lakhs. Now I'm not exaggerating here. What you need is 5 crore 62 lakhs as a corpus, so that you can afford to take 2,30,000 on a monthly basis, 35 years down the line, and we are planning up to the age of 62 lakhs when I retire. How do I go about saving it? There are calculations available. There are, formula. Excel sheet is your best friend. When it comes to Excel sheet, is like a best friend. So always remember, if anybody is interested in these calculators, I can share it with you if you share your email IDs. So we are looking at creation of a corpus of 5,62,000, right? And the number of months we have is 35 years into 12. So we are looking at a very moderate portfolio here. In the first column, we are looking at a moderate portfolio which is giving us 8%. In the second column, we are looking at a little aggressive portfolio which will have a little more of equity. So we are assuming a return of 14% here. With a very moderate and a conservative kind of portfolio, from today, if you save 22,800, you will accumulate a corpus of 5 crore 62 lakhs at the time of retirement. Whereas if you look at an aggressive portfolio with a 14% return, you only need to invest 800 rupees today on a monthly basis at 14% for you to accumulate a corpus of 5 crore 62 lakhs at the time of retirement. I hope till now it is clear. Any doubts, please, you can chat up and ask me questions. Okay, so that is how you can plan for your retirement. In the same fashion, you can also go about planning for your other goals as well. You can put up the amount of corpus that you need today's term. You inflate it with that inflation percentage. Like for example, in education, you look at 10% as an inflation. In other things, you may look at 5% or 6% or the kind of current inflation. So you inflate it and you come to an arrival of corpus which is required after X number of years, and you break it down and you see how much of monthly investment is required to build that corpus over a period. Now we understand that it is important to invest, right? But at what rate? That is a very important question. It's a very important and an interesting question. So the rate of interest should at least beat your inflation. Now can somebody tell me what is inflation? In very simple terms, can you chat and tell me what is inflation? I'm presuming that most of you know what is inflation. Anybody can tell me a small basic definition of inflation? Increase in price. Yes, Obia. In very basic simple terms, it is the increase in prices of all commodities and goods around us, right? So, in simple ways to say, if you have 100 rupees and you walk into a vegetable shop and you buy a bag of vegetables today, 2 years down the line for the same bag of vegetables, you will have to spend 115 rupees or 120 rupees. So if you look at here in this chart, this is an actual chart at a 8%, 100 rupees will be worth only for corpus. This is something which you have to remember while investing, because if your investment is not delivering even the basic inflation, then technically speaking, you are having negative returns. For example, if you were to look at savings bank account and you think that I'm saving money and keeping the money in the bank, I have saved so much of money, the bank is giving you only 4%, whereas your current inflation is 7%. Technically, you're making negative returns, but also on the interests of savings and fixed deposits, you will end up paying taxes also. So you make a lot more negative return when it comes to fixed deposits or savings deposits, those kind of fixed income methods. So you need to invest into avenues which will beat inflation. Okay. Now, who's this? Can somebody tell me who this is? I'm sure many of you will know. Who is this? Anyone? Who is this old man? Can anyone tell me who this is? 100 participants or maybe 200 students. Anyone? Anybody knows who this is? Nobody. Okay, this is Warren Buffett. Okay. This is a very world famous personality in the field of investments. He is one of the most richest in the world today. Okay, he became rich only through his investments and nothing else. He has come from very, humble backgrounds, and he has become rich only because of his investments. He has made his first investment at the age of 11, and he firmly believes that he was wasting his life till then. So this is a risk trade-off. So you can, this is self, repetitive. It says about If you see here, your bank account, deposits, your government bonds, post office, PPF and all fall under almost zero risk. You can categorize them as zero risk, but they will also be giving you very low returns. So the returns offered today in a savings bank deposits or FD rate for SBI 1 year deposit is at 5 to 5.9%. That is the current range which is there. So the lower the risk, the lower the return. And if you see, the products are having higher the risk, higher the returns, and this is how it is started. Now the topmost are your derivatives, and then after this would come your crypto, which is and sometimes very high returns or very low returns depending upon the knowledge you have in the field. Okay. Now, yes. So let us look at, 1 second, I'll just stop sharing this. It's a different PPT which is. I'm sorry, I'm just taking a minute. I'm just pulling out the right PPT. I'm sorry for the delay. Yes. Okay. Yeah, that's okay. Okay. Now, when it comes to stocks, how do you go about investing? When it comes to stocks, what is the most important thing to do? When it comes to stock, how do you go about investing is through two things. One is invest for the long term. Long term investing is very important because of two things. One is because you will make good amount of returns in the long term. What is long term? Any idea what is long term? Can anyone tell me what is long term? What ideally is long term? Anyone can tell me what is long term? More than 5 years, says Azlina. Anybody? Anyone else? Yes, more than a year, says Kavita. No, more than a year is not considered as long term. What ideally is long term is more than 7 years is considered as long term in the financial markets. The reason for that is two things. There are two reasons for that. One is any point to any point in the last several decades since the inception of, say, Sensex or Nifty. If you were to chart the graphs and you take from any point to the next 7 years point, it has always been a positive return. Second is, in the long term, it as always tends to give you 16% kind of a return, which is very, very the right PD. Just give me a minute. Yes. Okay. So before we go directly into stocks, let us talk a little more about each asset class. So first, let us talk about fixed income. What do you think are the different avenues of investments before we come to fixed income? What are the different avenues of investments, or what do you think? Where do you think is the right investment? What is the right investment option? What according to you is the right investment option? Anyone? There are so many investment options available in the market today. What do you think is the best investment? Does anyone have an idea? There are so many investment options available these days. Anyone? Investment in securities, says you are Rani. Yes, that is equity. So you're talking about stock markets. Anyone else? Which is the best investment option available? Anyone? You have more than 100 students. Hands on your phones, please. Land. Halima says land. Gold. Yes. Very interesting. Anyone else? Okay. So there are so many. There are thousands and tens and thousands of investment options available in the market today. We have equity stocks. We have FDs. We have PPF. We have NSE. Right? Kisan Vikas Patra. We have equity stocks. We have mutual funds. We have ETFs, which are exchange traded funds. We have gold. In gold, we have direct gold. We have sovereign bonds, right? In real estate, again, we have certain real estate funds also today. Okay, direct real estate. Even real estate, we have commercial properties. We have residential properties. We have so many categories and so many avenues of investments. But always remember, all these avenues of investments can be basically categorized into four asset classes. One is your fixed income, which is called as debt. Second is your equity. Equity can comprise of direct equity or through mutual funds. Third is gold, and fourth is real estate. So there are always only four asset classes. One is fixed income, equity, gold, and real estate. So let us understand a little more as to what is fixed income. Fixed income is any avenue where the return is fixed. So before you invest the money, you know how much you are going to make at the end of the year. Like for instance, your FDs, you know what is the rate you are going to get end of the year. So when I'm saying about 4% being given in savings deposit or 5.9% in fixed deposit and inflation eating out into that, does it mean to say that don't invest anything into FD? No. Okay. So we cannot outrightly scratch out any investment option or any asset class for that matter. Each asset class has a role to play in your portfolio. Suppose you're looking at buying an iPhone, say 6 months down the line, and you have already collected 1 lakh rupees in your account. Okay. And you're looking at buying that phone. Say you invest that money in equity today, and 6 months down the line, if the markets have tanked, 6 months down the line, when you actually want to buy the phone, you will not be able to pull out the money. So ideally for any of your short-term goals, short-term is anywhere less than 3 years. All these short-term goal corpuses and funds, you have to pocket in fixed income category. Fixed income category does not only mean savings deposit or fixed deposit, it can also mean debt mutual funds. Debt mutual funds offer you much better returns when compared to savings deposit or fixed deposit. The returns can range anywhere between 6% to 12% depending upon the category of debt mutual funds that you are looking at. Plus, we also spoke about the 50-30-20 rule earlier, right? Where 20% of the investment always has to be liquid. It should be always readily accessible. Even that money you can park it in fixed income. Okay. So next, let us look at what is the next asset class. The next asset class is equity. Equity you can invest in two ways. One is through direct stocks, one is through mutual funds. What is direct stock investing? Can somebody tell me in very easy terms what is direct equity stock investment? What do you actually mean by equity? Does anyone have an idea of what is equity? Very simple terms, very basic terms. What is equity? Anyone? What is equity investments? Anyone? So many students, so many 95 plus participants. Anyone? What is equity? Okay, I'm going ahead and explaining. Equity in very basic terms is investing in somebody's business. Okay, suppose you have a neighbor who comes to you and he says, I'm starting a business. Okay, I would want some funds. I need some help. Can you please invest in my business? What will you do? You will first understand the business model. You will first ask him, what is your business model? How do you propose to make money for yourself and how do you propose to give me profits? Only then I can invest in your business. And maybe you decide to invest or otherwise, depending upon his answers. Now, if you have faith in that business model and you invest in his business, that is the basic definition of equity. Now, if you have faith in Ambani, you will go ahead and buy a stock of Reliance. So in very simple terms, you are owning a part of that business. Yes, if you have one single equity share of Reliance, it doesn't make you the owner of Reliance 100%. You have a 0.00001% of ownership. So when the company declares dividends, you make money. When the company's stock price appreciates, you make money. So these are the two ways where you make money from equity. Now, what is a mutual fund? Can anyone tell me what's a mutual fund? In very simple terms, what is a mutual fund? Any idea what's a mutual fund? Anybody? Very basic, simple terms. What is a mutual fund? Okay, now let us assume that you are about 150 students, right? So 150 to 200 students. If each of you have, say, 100 rupees, okay, and you would want to invest that into stock markets. Now, you don't have the wherewithal to do the analysis and research on Google on each particular stock, and you don't know where to invest, right? So if you are, say, 100 students, you have 100 rupees each, you find that 101 first person, he is the fund manager, you tell him, we all will give you the money, you please manage the portfolio for us. Because the fund manager is more knowledgeable and he's adept of the market situations and he can do the analysis. So what he does is he collects the pool of investments from all of you, 100 and 200. He will collect 10,000 rupees from all of you and he will do the research and analysis. He will finalize about 20 to 30 stocks and he will invest into those stocks. Now, whatever profits are coming from there in the form of either capital appreciation or dividends, he may charge a small fee for that, say 1% or 1.5%. Each mutual fund is different. You need to look at their expense ratios to understand what is the fees that they charge, and they pass on the returns to the investor. So this is how the mutual fund concept works. This is the easiest and the best way to look at equity as an investment because you have access to their research, which we as common people cannot do. So invest for long term and do your analysis are the key when it comes to investing in equity. Now, how do you go about investing in equity? Can anybody tell me how to go about doing research on a particular stock? For example, if I've identified X stock as a good investment, how should I go about understanding is it actually a good investment or not? Any idea? Can somebody tell me? How to understand whether it is a good investment or not? Anyone? Can anyone tell me how to? Fixed rate of return. Parveen says fixed rate of return, stock value. Anyone else? Stock value, yes, is an indicator of how the company is doing well, but what else do you do to understand is that X company good or not? What else can you do to make sure that it is a good company or not, whether I can invest or not? Anyone else? Okay, so this is called as fundamental analysis. Always remember this word. It is called as fundamental analysis, which looks into the books of this particular stock to understand and analyze where to invest. Okay, so choose companies with strong fundamentals. Now, how do you go about doing fundamental analysis? The most and foremost important thing to look at would be the annual report. Annual report is a statement which has to be mandatorily published by each of the companies, and they publish it on a yearly basis. It has to be available for reading by everybody on their respective websites and on NSE and BSE websites also. Suppose you want to read the books of annual reports of, say, Reliance, it is available on their website, it is available on NSE, it is available on BSE. So these are long documents. These are 200, 300 page long documents. You need to know what to look at into these documents to understand how the business is doing. Now, what are the three main important things to look at in an annual report is, one is the balance sheet, second is the profit and loss statement, and then the cash flow statement. So these three things are what will give you an idea as to how the company is doing. Now, when you're looking at these three things, always remember to do these two kinds of analysis. One is you have to look at the past performance. A standalone performance will not help you at all. So if you're looking at say 2022 numbers, those numbers alone will not tell you anything until and unless you compare it with 2021 and 2020. The numbers have to be growing. If there is a problem in the last 1 year or 2 years, you need to delve deeper and understand why there has been a problem. So that is one aspect of analysis. The second aspect of analysis is peer group comparison, where you look at the competition. Suppose if I'm looking at Asian Paints as a stock, looking at only Asian Paints number does not serve any purpose. I can look at Asian Paints numbers vis-a-vis the numbers of say Berger Paints. Okay. So then I understand how is the customer base of each of these companies, which has a better base, who is investing more into research and development, who has a better presence in the markets, who has better prospect going forward, and who will make better money for me. Where do I invest? That is a main question that we are trying to answer by doing all these analysis. Then we need to look at the promoter background. How are they? Do they have a sound background or not? Are there any pending litigations against the company? Okay, so all these things have to be looked at before deciding where to invest. Please don't get carried away by rumors of say neighbors or any other brokers and people like that who come and tell you this is a very good proposition, please invest. Okay, go with only authorized brokers, choose SEBI registered brokers only. Let not greed make you an easy prey. Beware of schemes which promise you to make rich very fast. Okay. Now another very important aspect of investment is, say for example, you have designed a very beautiful portfolio, okay, with all asset classes. You have stocks, you have some mutual funds, you have gold, you have debt, you have everything in your portfolio. It is beautifully designed. It is designed in a fashion where it will even give you say 14 to 16% return, and you leave it at that and you sleep over it for the next 5 years. Okay. After 5 years or say 10 years, if you open the portfolio and look at it, things would have drastically changed. Okay, so that is not a way to invest and grow. Once you invest, you have to make sure that every now and then you revisit the portfolio. Okay, that doesn't mean you look at the screen on a daily basis, because the stock prices move up and down on a daily basis or an hourly basis or even minute by minute. You cannot keep monitoring that. That is not a way to invest. That is a trader mentality. So ideally what you should do is, once you invest, revisit your portfolio say 6 months down the line or 1 year down the line and see, are there any bad apples in my portfolio? Do I have to exit any bad apples? And do I reinvest it elsewhere? Sometimes it also so happens that, say for example, if you have a 70-30 portfolio where 70% is in equity and 30% is in debt, if the markets are doing exceptionally well, your 70% would have grown to 90%. So your portfolio becomes 90-10. It is a very risky portfolio because you have 90% in equity. If the markets were to tank, your portfolio is going to crash completely. So you have to rebalance your portfolio and bring it back to 70%, which is your comfort allocation. So these are the things which you need to see. Okay. Now, what are the ways to reduce risk in equity? So basically, these are the 3 ways to reduce risk in equity. One is you look at long, we will understand in a little more detail why long term is. Mitigate risk in equity. Mitigate risk in equity is gold. Okay, gold and asset class has always had an inverse relationship with equity. Every time the equities have crashed, gold prices have gone up. Okay, so and that is why always remember this word. It is called as hedge against equity. Gold is considered as a hedge against equity. So always remember to be an investor and not a trader. It is very easy to get swayed by market movements and exit and enter, but that is not an ideal way to build a corpus and look at financial goals which will cater to your requirements. Okay, here is a very interesting calculation. This is a very interesting chart to look at. Let me just run you through this. Okay, see, for example, this is a real chart of say Sensex. For example, if somebody had invested their money here in 2007, okay, the money would have lost about 52%. If somebody had invested here, right, he would have made 79%. Now, when I'm looking at this chart, right, I'm looking at it from the past. So it is very easy for me to today point out and say it is better to invest here, it is not good to invest here. But at that point in time when you are there, it is not easy to time the market. So one should never attempt to time the market. Even Warren Buffett cannot time the market. If somebody had invested in 2003 and stay put all way through till 2018, that person would have made 16% return year on year. So this is the beauty of equity. So when you stay put for longer term and you have a discipline, then you make decent 14 to 16% returns on a year basis. Okay. Now let us come to mutual funds. Can someone tell me what is a mutual fund? Again, in a very simple term. What are the advantages of investing in mutual funds? What are the advantages of investing in mutual funds? Anyone? Okay. As I mentioned earlier, mutual fund is nothing but a pool of investments and they pass on the returns to you. One is they give you a professionally managed kind of a portfolio. Second, they come with a lot of research and analysis. So these are different and they also offer a lot of tax benefits. So these are different benefits of investing in mutual funds. They bring their expertise into the field. So these are different categories of mutual funds which are there currently in the market. SEBI keeps defining these categories and they keep publishing the circulars time and again. Let us look at SIP. SIP is something which is very important for all of you because you're going to start your jobs shortly. SIP is something which you have to understand in detail. Can somebody tell me what is an SIP? Let me just quickly launch a poll so that let's see how many of you know what is an SIP. Fingers on your phones, please. Just a quick poll. Let us see what is SIP. Are we awake or are we dozing? Post-lunch session. Yes, we are awake. I see a lot of votes. What is SIP? Is it starting investment program, systematic investment plan, or systematic investment program? I have only 30 votes. What about others? Yes. Okay. So many of you seem to be aware and at what periods of time. Okay. In 20 years, if you've invested 5,000 rupees on a monthly basis for the next 20 years, you have made a corpus of 49 lakhs. Okay. This is the corpus you would have made. Now, if you have invested for the next 30 years, if you invested for 30 years, you would have accumulated a corpus of 1.76 crores. If you have done it for 35 years, just a disciplined 5,000 rupees per month will give you a corpus of 5.95 crores in 35 years. This is all that you need to do if you want to build a corpus of 5.95 crores. Now, please remember, this is at a very conservative 12% that I'm assuming. A lot of equity funds or a lot of your portfolios when you design can also be giving you much more than 12%. Even if you look at a very conservative 12%, you can accumulate this corpus in the next 35 years to come. So that's the power of investing regularly, and it is the power of investing over a long-term period. So this, in the same manner, if you invest 1,000 rupees, what is the kind of corpus that will be created in the next 40 years? Are these numbers. Okay. Now, please spend some time on this particular chart. This is a very important chart. Okay. I'll just explain to you. Now, we all saw how 49 lakhs was accumulated by investing 5,000 rupees SIP. Now, here we are discussing a concept called as step-up SIP, which is a very important and very interesting concept. Now, your salaries will be increasing year on year. You will be making bonuses year on year. So, ideally speaking, your investments also should be increasing year on year. Okay. So, suppose if we look at a 10% increase year on year, year's time, first year you invest 5,000, second year you invest 5,500 rupees into 12, third year again 10% on 5,500, accumulating a corpus of 99 lakhs and a corpus of 1.1 crores in years if you were to increase your SIP by 15%. Okay. In the same manner, if if you were to look at a 35-year period, you will be accumulating a corpus of 18 crores. This is not an exaggerated number. Mind you, these are real numbers charted with formulas. You will accumulate 18 crores 75 lakhs if you step up your SIP just from 5 years and 35 years. So let us now quickly look at the real example. I'm sure you will find this very, very interesting. I'll just run you through a real fund. Okay, I have just jotted down a real fund, NAV, over a period of certain time. Okay, I would like all of you to be a little more participating here so that it is interesting and we have a very good takeaway. So we start our journey in 2007. April at 136 rupees as the NAV. NAV is nothing but you can look at NAV as a price of a mutual fund. Okay, like the way stock price is, net asset value, there is a certain formula by which it is calculated, but in very basic terms, it is the price of a mutual fund for that particular day. Okay, so we start our journey at 136 in 2007. Say we invest 1 lakh rupees. So we have accumulated 731. Let's forward and we come to 2008. Our 136 has moved to rupees invested is 1,64,000 rupees. How many of you would stay? How many of you would sell? What would you do? Would you sell or would you stay? What will you do? How many of you will stay? How many of you will sell? Sell. Halima says sell. Anyone else wants to sell? Syed Azlima also says sell. Azlina also wants to sell. Nobody wants to say stay. Azlina wants to stay. Anyone wants to stay? Anyone wants to sell? Anyone else? Okay. Let us see what happens going forward. Okay. So all those people who stayed, see what happened. Yeah. 2009. It is now at 96. Now what would you like to do? Your 1 lakh invested went up to 1,60,000, came back to 70,000. Now what would you like to do? Now would you want to stay or sell? Anyone? You want to stay or you want to sell? More participation, please. You want to stay, you want to sell? Stay. Many of them are saying stay. Yes. Not exit. Halima wants to sell. At a loss of 30,000 rupees, you want to sell. Many of them want to stay because you don't want to exit at a loss. Now, this is just an example. Okay. Let us see what has happened in 2022. Okay. See where the NAV has gone. Went up to 600. It has gone back to 500. Now, in March 2022, it was at 1,000 rupees. So if somebody had invested in 2007 1 lakh rupees, it would have been 7,39,000. The same thing if you had invested 10 lakhs, it would have been 73 lakhs, right? So that is the power of compounding and that is the beauty of long-term investment in equity. Let us come back to our presentation. Okay. Now let us come to gold as an asset class. Now gold, I'm sure many women here, when most of you are, all of you are women, yes, I'm so sorry. So all of you will be interested with this particular asset class. Gold as an asset class is very attractive to us. Then it is not considered as an investment. Always remember, if you're buying gold invested as well, like say ETFs or gold mutual funds, there are solid gold bars available. Also, there are sovereign gold bonds available. What are sovereign gold bonds? They have a lock-in of say 5 to 7 years. They give you a return of say 2.5%. At the time of, the lock-in is, when the lock-in is over and at the time of maturity, you will get the price of gold at that given point in time. So you make the appreciation of gold also, plus you make 2.5% return on a yearly basis, which is a very decent return looking at the way the gold. Okay. Now let me give you a very quick example. All of us have different modes of payments, right? I would rather want to go and do a GPay. Now, if I take the same 2,000 rupees in my wallet and walk into a shopping mall, I may end up spending much more than that 2,000 rupees. So at that time, what will I do? I will use my debit card, or most of us might be also having credit card, so I might use a credit card. Now, if I go to a gold shop and I want to buy a jewelry set, right? And maybe it is say 1 lakh or 2 lakh of rupees. I neither have money in my account nor my credit limit is as much. Then what will I do? I would rather ask my dad and take a check leaf from him and give a check leaf as a payment method. So all of us have different methods of payment available to us, but depending upon what the situation is, we will use one particular payment method. So your portfolio is actually your weapon. Always remember, it is a weapon that you create to achieve your financial goals in the long run. So all these asset classes are your weapons: gold, equity, your real estate, and debt. All of them have to be used appropriately depending upon the situation. So never put all your eggs in one basket. Make sure you have something in each of it. How to arrive at that particular percentage in each of it is with this particular depiction. Now, this is a very basic and a simple depiction which is given here. Okay, the thumb rule generally is that 100 minus your age should be your equity allocation. For example, 100 minus 30, say you're 30, 100 minus 30, which is 70%, should be in equity. Can anyone tell me why the younger you are, the higher is your equity exposure? Any guesses, wild guesses? Why ideally it is said the younger you are, the higher should be your equity exposure? Anyone has any idea why this logic fits? Anyone? Can someone tell me why the younger you are, the higher the equity allocation? Nobody? Okay, let me tell you. The younger you are, the more time you have available on hand. Now, if I'm 60 years old and I've accumulated a corpus working all through my life and I put it in equity, right? And if the markets were to tank tomorrow and I have a medical emergency, okay, I will not be able to pull out that money. So the older you are, you would want to go into safer asset classes like, say, debt, for example. The younger you are, you can afford to be more aggressive and you can have higher equity. So based on that, you have these different categories. Moderately conservative, a moderate person will have 50-50 and an aggressive person will have more into equity. Any doubts at any given point in time, please feel free to chat with me. I will answer all your questions to the best of my abilities. Okay, now documentation is the key. We are almost at the end of the presentation, so we can come back to revisit the questions also at a later point in time. So documentation is the key. Always remember to document all your investments, and please remember to nominate all your investments. I have personally seen a lot of cases where people have really struggled because the process of claiming something where the nominee is not registered is extremely tedious. Okay. You can also consider career as a financial planner because there is a dearth of financial planner in the markets today. I'm sure most of you would have come across, or your parents would have come across, people who are trying to sell them insurance or who are trying to sell them one particular product. So there are more of product sellers these days in the market than a holistic financial planner. A holistic financial planner will give a proper plan which will include all asset classes and help you achieve your financial goals. So you can also consider being a financial planner because NSE offers a lot of courses. They have NCFM certification programs and they have myriad programs available on their website. So you can be NSE certified, which will make you interview ready. Okay, so these are different initiatives by NSE. They also have tie-ups with universities. They have postgraduate programs. Please do visit the NSE website to understand a little more in detail. Yes, सोच कर, समझ कर, invest कर. Any questions? Please feel free to ask. I will just unmute so that you can ask questions. You can unmute yourself in case you have any questions.
so much, ma'am. That was an interesting and informative webinar on financial wellness. As I have received few questions from the students, I would like to ask you these questions on behalf of them. Shall I, ma'am?
Please, please.
The first question is, how much can we rely on?
How much can we rely on? I'm unable to hear you. How much can we rely on?
Borrowing, ma'am.
On borrowing, is it? How much can we rely on borrowing? Okay, so I'm assuming that you mean to say that you are talking about borrowing in terms of personal loans or housing loans and things like that. Let me give you a little more details about it. Housing loan has a lot of advantages. Housing loan gives you a lot of deductions in the taxable income. You have about 1.5 lakhs which you can deduct from your taxable income as per section 80 CCD, and you also can claim the principal amount up to 2 lakh rupees under another section. So these are benefits which are offered to you for home loans. Personal loans I would personally not recommend because the interest rates on personal loans are extremely high. So personal loans should be taken unless and you don't have other source of equity. These things you should have a lot of. Please remember, if you're looking at borrowing with respect to home loan, please look at the EMI calculator. Okay. Also, a very interesting aspect of EMIs and loans is that if you calculate the total payments that you make, please observe if you've taken a loan of say 20 lakhs to lakhs and you're going to pay it back in 20 years with their EMI calculator that says 7% or 8%, the actual amount that you're going to pay back is around 40 to 45 lakhs. If you take a real loan and calculate this EMI and see, you will end up paying almost double the amount in that 20 years or 30 years. So ideally, loans should be taken only as an emergency at that point in time, and as and how you are able to, accumulate some bit of money every now and then, please do prepayment and close the loans at the earliest possible. I hope that answers the question.
Yes, thank you, ma'am. There is another question, ma'am. Can I
Please tell
ask?
me. Yes, please tell me.
What are the short-term investment plans, ma'am?
Short-term investment plans. So short-term investment plans ideally should be looked at into the debt category because equity is ideal for long-term and not short-term. So when it comes to short-term as investment plans, debt mutual funds are ideally a very good proposition as compared to your FD or savings bank account because the rates of return in savings or FDs are very low when compared to debt mutual funds. Now, when you're talking about debt mutual funds, please do a little bit of research in that because there are so many categories and types of debt mutual funds. Even in debt mutual funds, there are government security mutual funds which invest only into G-Secs. They are extremely volatile. In a falling interest rate scenario, these funds tend to do extremely well. But if the interest rates are rising over a period, these funds are extremely volatile and more deadly and dangerous than equity. Okay. There are short-term income plans. There are shorter maturity plans, shorter duration plans. These are ideal. So you look at the papers of that particular debt mutual fund where it is invested for 3 to 5 years. Those kind of funds you should consider. Ideally, when you're starting your investments, it is always better and you're always safer in a mutual fund route rather than a direct product route. So mutual funds are a safer way to invest into equity or debt for that matter. I hope that answers your question.
Yes, ma'am. Thank you, ma'am. There is one last
Tell me.
question, ma'am. Can I ask?
Tell me, please.
As a student, how can
A very real way to go about it is, I'm sure you all have your basic expenses, which you cannot avoid, right? Maybe your rent, your shopping for the month, which may include your stationery supplies or your college supplies. You may have festival shoppings, travel shoppings, which you cannot avoid, like say bus, hiring or auto rentals. All these things you cannot avoid. So jot down what is that amount and you deduct that amount from your salary when you start on your jobs. Okay. And then you go about saving that amount. Now, as a student, when you don't have salaries, if you're asking me about that, then you will have to be very, very diligent in planning, meticulous in planning. Even as a student, you can start your investments. There is no hard and fast rule that you cannot start investing when you don't have salaries or when you're just students. You can start investing into mutual funds with as low as 100 rupees. Okay. So please start your do a little bit of research and start investing at the earliest, because I've shown you in detail how the sooner you start, the bigger is the corpus that you can accumulate. You will not even imagine the kind of corpus that you can accumulate over the long run if you start early. The earlier, the better. Does that answer the question, Sabha?
Yes, ma'am. Thank you so much, ma'am, for answering all the questions. I hope our students have received their answers.
I would like to mention one particular thing here. I am thankful to all of you because you have been a very nice bunch, very courteous bunch. Thank you for a well-behaved bunch.
Thank you so much, ma'am.
Thank you.
Thankfulness is the beginning of gratitude. Gratitude is the completion of thankfulness. Now, Syed Azhina of third year ISN will deliver the word of thanks.
Gratitude makes sense of past, bring peace for today, and creates a vision for tomorrow. It's my privilege to have been here to propose a vote of thanks for the program. First and foremost, I would like to thank program coordinator of Friend Edu Connect and Movers Learning Academy who have organized this program. My heartfelt thanks to our chief guest and speaker, Ms. Suman K. Karan, for her gracious presence and the valuable knowledge she extremely fruitful. Business Studies and head of the Department of Corporate Secretaryship and Information Systems Management for her support and encouragement for this program. My heartfelt thanks to all the students involved in organizing for their team, thank the students for their presence, active participation, support, and patient listening. Thank you, ma'am.
Thank you, Sabha.
Thank you so much, Syed.
Yeah. Good evening. This is Sonia Soman from Team EduConnect. We are an organization that has been entrusted to coordinate the financial educational programs to SEGI and NSE for Novice Learning Academy, Bengaluru. Novice Learning Academy has conducted the session in association with the Department of Corporate Secretaryship and Information System College for Women. Dr. Ampul Azrin. We also thank Dr. Firdaus Jahan, the Vice Principal, and we extend our wholehearted gratitude to Dr. B. Barakat, HOD of Department Dr. Rahim and Ms. Ma, who coordinated with me in every step of the way. We extend our immense gratitude to all those who have collaborated with us for the conduct of the program, especially the technical team. a big thank you to all our dear participants. My dear girls, I must tell you, this is a large South India. So I have coordinated 10 programs in 5 different states, and this was the best.
Yes, Miss Sonia, I would like to add one statement here.
Well behaved, yes, well behaved, courteous, and very attentive, and your active participation. Thank you very much, dear students. Way to go. Please, Suman, you want to say something?
I was just saying, by far, this has been the best batch, that I have trained also. In spite of being such a large in number, I am so happy and thankful to you that you have been so courteous and well disciplined. I also appreciate the discipline of accumulating the questions to one person and that one person unmuting and talking. Thank you, Sabah, for giving a lovely vote of thanks. Thanks once again to all the faculties for managing and raising such wonderfully well-behaved children.
Thank you, Suman. And our sincere gratitude is extended to Justice Bashir Ahmed Said College for Women, Chennai. And it was an extremely good session in spite of the technical glitch. And we would like to maintain this association with this college and possibly conduct more sessions like this together in the future. Thank you very much.
I hope
did I miss anything?
I hope the session yes, I'm sorry. I hope the session has added value to all of you. Yes.
Yeah. Thank you very much for your patient listening. And you've been waiting for long, I understand. Thank you very much.
Thank you so much, ma'am.
Thank you very much. This has been the second time that we have been associating with you and your department.
Thank you so much.
Have a happy weekend. Have a great weekend. Goodbye.
Thank you. Shall I end the session, Sonia?
Thank you so much, ma'am. Now, request you all to rise for the night.
Thank you, Suman. Thank you for waiting so patiently. I understand that you had waited for more
No
than 1
worries,
hour.
absolutely.
Sorry.
Worth it for the kind of session they made me do. So, thank you.
Thank you. Bye. Bye.
Happy weekend to all of you. Bye.
Bye.